As you watch this video, a cover housing crash is taking place. While many appear to be ignoring the obvious, the real estate market has reached a crisis mode, and what awaits the United States in 2023 might be a calamity worse than what we experienced in 2008. While many people remain unconvinced due to some contradicting reports, new data points to a complicated future. One of the first things you'll hear from crash skeptics is that nationwide, prices show no signs of a decline, which is technically correct. The Shiller index is the most well-known and often used index in the United States for measuring housing prices. According to the most recent report for September 2022, home values have fallen by barely 2.5% since their peak in June. As a result, many argue that homes are merely cooling and that a crash is unlikely because we are still 38% higher than pre-pandemic levels. But this gauge isn't really capturing what is happening on the ground right now. Without boring you to death, the Shiller is famous for being a lagging indicator. If you truly dig into the technical details of how the Shiller index is calculated, you will notice that it employs an average number that looks back approximately 3 months. This means that while home values may be falling, the shift will not appear as severe in the Shiller, especially in the early stages of a downtrend. This isn't just my view, we can verify it by looking at Redfin's numbers. As you may know, Redfin is primarily a real estate listing platform with one of the world's largest real estate data sets. Not only are their numbers precise, but they are also quick. Redfin can analyze listings in real time and calculate averages without having to sift through county data, which are frequently delayed and lag behind the prices we see displayed on websites like Zillow and other real estate software companies. Essentially, the case is a terrific indication, but it, like many others, frequently lags what is happening in the markets in real time. Thus, the big question is, what do these figures say? As previously stated, the Shiller peaked in June of 2022, whereas the Redfin figures peaked in May, 1 month before the Shiller. This may not appear to be a significant concern, but if we dig further, we can discover an evident divergence that explains why so many investors are panicking in light of the Shiller collapse. Prices have plummeted by 2.5% from top to bottom, according to the Shiller, which is almost of no meaning. Meanwhile, according to Redfin research, prices have already dropped 12.6%, which is a significant difference in the real estate world. Remember that prices rarely shift year over year, so a 13% decline in a few months is a huge warning that should tell you everything you need to know about the future of the housing market. At the end of the day, the Shiller is simply not keeping up with the speed of the collision. The fact is hidden. The crash has already started, and it's not just YouTubers who are talking about it. Fortune magazine's Lance Lambert recently spoke with CoStar CEO Andy Florence. Many consider CoStar to be a global leader in commercial real estate analytics and information, and the CEO was very clear about where he thinks the market is going, saying, quote, "People who think a 10% drop in home prices is what's coming are dreaming. A 20% dip is more comfortable." There are many institutions making similar comments. KPMG, one of the country's largest and most reputable accounting firms, just reported that they estimate the Shiller to plummet 20% by the fourth quarter of 2023, and keep in mind that this is the national average. In inflated markets, the harm would be far greater. For example, in Boise, Idaho, which we can argue was the most inflated market in the US after the pandemic, prices have already dropped by more than 20%, despite the national average is down only 13% by those same Redfin numbers. This is more than double the national average, and dozens of other American territories are in the same boat. So you're probably wondering what comes next. So if you're enjoying the video so far, I hope you'll hit the like and subscribe button. Now let's return to the crash. If prices are down 13% nationally, according to what is likely the most accurate estimate, and down more than 20% in hot regions, where is this all going? Many believe that this year will be worse than 2008. When experts analyze a disaster like this, the source is always the first thing that comes up. Everyone knows that the housing market broke in 2008 owing to faulty loans. This was widely depicted in the infamous film The Big Short, and essentially, what happened was that loans became far too easy to obtain, causing home ownership to skyrocket, but not in a positive way. Too many people were buying with income that did not match the debt they were inheriting, and new subprime markets enabled consumers to enter loans with teaser rates that gave the illusion of affordability. Everything blew up with the subprime market exploding in housing shortly following, in a long downward spiral along with the entire economy. However, loans today appear to be radically different. Standards have improved, restrictions have been modified, and the subprime market is basically non-existent. So if the foundation is strong and healthy, what could lead the market to crash? The answer is quite simple, and for some reason isn't discussed. For the past 10 years, big Wall Street investors have moved in and transformed the single-family housing markets. Companies such as Opendoor, OfferPad, Zillow, and countless others have entered communities and started acquiring real estate. These are known as iBuyer programs. Essentially, it was a business where you could get an instant offer for your house, and this enormous organization would come in and buy it for cash. This changed the market because the bids were frequently more than fair. In fact, in many cases, corporations were offering far more than what appeared to be fair value. These were enormous tech props, unprofitable giants that weren't focused on profitability, but rather on growth. Therefore, in many cases, these massive institutions were competing for market share. They were attempting to buy up entire towns, even if it meant losing some money on each property. What this did was create an atmosphere where values got higher. Purchasers were buying hundreds of thousands of homes and then relisting them for big amounts of money, thus inflating markets. This worked for many years, particularly during the post-pandemic boom, as extremely low interest rates and a euphoric environment pushed prices along at a rate never seen before in history. As a matter of fact, the entire operation was a self-feeding loop, as these companies inflated entire neighborhoods, attracting mom and pop investors. Smaller operations that practiced the real estate churn mentality. Buy a property, repaint the floors, and paint the rooms before selling for a profit. This type of conduct inflated prices even more, and what was left was a situation in which investors constituted a big number of buyers. According to Redfin reports, in Q4 of 2021, investors bought roughly 1 in every 5 properties sold in the United States. This is without even discussing the fact that in other places, such as Vegas, approximately 30% of all residences sold that quarter went to an investor. And these percentages are likely diluted with other data just by using simple logic. If we exclude homes sold through private transactions and only look at mid-priced homes sold and attracted to neighborhoods, that percentage would surely rise to something crazy. The fact is that investors essentially took over the market last year, and this is now all exploding, leading to the final point. The source of this collapse will not come from bad loans, but from the complete implosion of iBuyers. We've already seen Redfin liquidate their single-family holdings, and with others facing bankruptcy, it's only a matter of time before we see a complete exit of investors from the market. Remember that in 2008, subprime mortgages were just 13% of total mortgage origination, and that 13%, even when diluted by everyone else who already had a mortgage, and those who had mortgages paid off, was enough to send the entire market down. With approximately 15% to 20% of all homes going to investors, what happens when they all pull out at the same time? The same processes that lead prices to swiftly soar will suddenly do the opposite, especially in the face of increasing rates and a sluggish economy. When you look at firms like Opendoor, which lost $928 million in Q3 of only, you have to wonder about the future of this industry. Many argue that the company is on the verge of bankruptcy. For instance, if you do some research, you will find that in the San Francisco suburbs, Opendoor simply can't move its inventory. In some cases, you will find that they list a house's for around $2 million, and merely 6 months later, it's still for sale with a nearly $500,000 price cut. Multiply this scenario thousands of times, and you can see why many are wondering. How many months does this company have left, and how much of the industry will suffer if they liquidate? Whatever the case may be, we are in for an intriguing 2023 as purchasers and investors abandon real estate following record-breaking price drops. Thank you for watching, and as always, please like and subscribe if you loved it, and don't forget to leave a comment below. This is CryptoWalk. I'll see you in the next one.